Well, thank you everyone for attending this webinar today. This is the third in our series of webinars under the Space to Grow program, Investment Readiness, where we help and encourage businesses, entrepreneurs to become investment ready and to seek investment from high net worth individuals, VC funds, and those who are interested in innovative businesses. This is the third in our series of informative webinars. And please don't miss next week's webinars on Tuesday and Wednesday, where we will be looking on Tuesday at understanding what is needed in a pitch deck that will attract the right investment, all those essential facts that you need to know. And it's an extremely informative webinar, followed by Wednesday, where we will be having live pitching. And if you are interested in pitching for investment, then please let us know at uez@essex.co.uk or through our usual channels by emailing myself or Josh Clark. So today we are going to talk about the really interesting subject, and I do mean it really is an interesting subject, of tax reliefs, because tax reliefs are not just there for the investor, they're there for the entrepreneur as well. And it's important to understand the reason why investors invest and what kind of incentives they would be looking for. In yesterday's webinar, you heard that some investors rely on tax reliefs and that influences the way they invest. But here we're going to find out in much more detail of how that works for the entrepreneur and how you can make it work for you. And that's the important side. So we have Colin Downing from BDO, who is a senior tax manager and deals with a wide range of businesses and corporate groups across a number of sectors. But the point is, he's got first-hand experience of helping entrepreneurs get their tax-efficient investments ready and helping investors understand what they need to know going forward. So he sits on both sides of the fence for this one, and that's useful for you to know. He's your friendly guide. But before we start with this full presentation, I would like to actually run a poll just to test to see where you are at your stage of investment. Josh, would you like to run that poll for me, please? Have you already decided on your investment strategy? And we'll just give you 30 seconds to answer this one. Thank you very much indeed. We can end that poll and let's see what the results are. Yeah, we can see that the majority of you have actually said that you have decided on your investment strategy. We'll be asking you the same question again at the end of this presentation. So thank you very much for sharing those results. And Colin, as I said, Colin has got a wealth of experience in the tax field. It is a very dry subject. And so you do need to be able to understand this quite in detail. So please, Colin, would you like to take over the webinar, please? Thank you.
Yes, thank you, John. Good afternoon, everyone. Amongst the various options that you have for obtaining investment in your business, there are a limited few where you can actually get tax relief or where the individuals get tax relief. And I'm going to be talking about two of those today. First of all, the Enterprise Investment Scheme, or EIS, which has been around for quite a long time now, and then its younger sibling, the Seed Enterprise Investment Scheme, or SEIS. So let's move on to the next slide. There we go. Back one. Right, so today we're going to cover what's in it for the investor and some of the pitfalls, the company requirements, including knowledge investment companies, and then finally how to get the relief itself and what you need to do and the various hoops that we need to go through. So a bit of a recap on the Enterprise Investment Scheme first. This was introduced back in 1994, so it's been around for quite a while now, a quarter of a century plus. And in that time, over 28,000 companies have obtained £18 billion worth of investment. So there's a fair amount of money flying around. The seed scheme has come along a bit later on in 2012, and that's mainly aimed at startups, and you'll see a bit further in that later on. And then lastly, I've just mentioned their venture capital trusts, or VCTs as they're shortened to. They cover startups and all the way to AIM listing, but they are less common than EIS and SEIS schemes. So what's the purpose of an EIS scheme in the first place? Why did it come about? Well, it was to encourage UK investors to invest in equity of unquoted trading companies in the UK. And in return for that, the government said, we'll give you some tax benefits. First of all, if it goes really well, then we'll give you some upside benefits. And if it all goes pear-shaped, then we'll give you some additional tax reliefs at the end of it. It also helps unquoted companies to raise finance in what they viewed at the time as the funding gap. So let's have a brief summary here. This table's really useful. I refer to this quite a lot, particularly when doing talks of this nature, and it's a very useful table for you to come back to and review. So if you pick up the slides afterwards, this one will be quite useful when you're exploring the different particular schemes that you might go into. So just very briefly there, you can see the tax relief along the top row, the different tax reliefs that apply. So SEIS gets 50%, EIS 30%, and VCTs 30%. The investor maximum, so you can see 100,000 there for SEIS, not a huge amount, but then we get to some bigger numbers for EIS. Tax-free exit, yes to all of those. I'll come on to that later on. VCTs are the only ones that get tax-free dividends. Capital gains exemption, there are some exemptions in there which I'll come on to later, and I've just noticed a typo because the 50% exemption should be under SEIS only, not under EIS, but that'll be covered in the later slides. Qualifying period, 3 years, 3 years and 5 years, a bit more on that later. And then inheritance tax exemption, which you don't get with VCTs, but you do with SEIS and EIS. So let's look at the investor release in quite a bit more detail now. So if you're an investor coming along, you're looking to invest using the EIS scheme or indeed the SEIS scheme, then there are a couple of things, needless to say, which must apply before you can actually qualify for the tax relief. So the first one is you must not be connected with the company. Now, what does connected mean? It means you mustn't be an employee. You can be potentially a director, but there are some angel rules there which are quite tough, and we'll come on to those later on. And you mustn't hold more than 30% of the shares in the company, and that includes any relatives. So you can't have a wife that owns 25% and you owning 25%. They will both be taken together and you'll exceed the 30% limit. I'll also come on to the 30% shareholding in a minute, particularly in relation to when you start up a company, because there are some unwelcome traps in there with founder shares or what typically happens just after that. So we do need to be very careful in that area. No related investment arrangements. In other words, if you invest in my company, I'll invest in your one, or something similar like that, or indeed any other related investment type vehicles with this particular company. No linked loans, so there's no lending into the company first or getting a loan from the company. Interestingly, there's no tax avoidance motive here, so you're not to be investing in the company just to get the tax relief. Now, it would be very rare, and I've never come across an investor who's actually putting quite a lot of money into a company just for the tax release. It's normally because they're looking for that, either the investment to give them a return, or they're interested in what the company actually does itself and want to help to make that company a success, and the tax release or benefits just happen to come off the side of it. An important one here is no value must be received from the company apart from a normal market rate remuneration, for example. So I'll come on to the director rules later on, where remuneration can be paid, but getting value from the company is a trap, which quite often, when we start off, it's great, no problem, but there is a 3-year qualifying period, as I mentioned in the last slide, and it's easily forgotten, and then all of a sudden you find that tax relief gets whipped away from you. EIS investors mustn't have other shares in the company apart from EIS, SEIS or VCT shares. Again, this is a bit of a trap here, because you can get your SEIS and EIS shares, and then sometime later on, perhaps there's another EIS investor who's looking to cash in and sell out, and you go, yeah, I'll have those, this company's doing really well. You buy his shares, and all of a sudden you then got non-EIS shares, and therefore you fall foul of that particular rule. So be very careful of that one. And I have come across situations where that has happened, and it wasn't a very pleasant conversation to have with the individuals concerned. Another thing with the EIS shares themselves, they must not have any preferential rights to dividends or cash on a winding up. So you can't have the first $500,000 on winding up the company if it goes bust. You just have to be in line with everybody else. Of course, the downside to that is you might have some other non-EIS investors who have got some preferential rights in there. So you need to look out for what's going on there. And then another unwelcome trap here, particularly if you're looking for capital gains tax disposal relief, which I'll come into some more detail later, you need to have claimed some of the income tax relief that's available. Even if it's only £1, you must have claimed some of it in order to get the disposal relief. If you don't, you just decide you don't need the income tax relief, then you won't get the disposal relief. And if the shares happen to rocket in value, you won't be very happy to have to pay some tax at the end of that. Okay, so income tax relief for EIS, it's up to 30% on, again, up to £1 million of investment. So if you invest £1 million, you could have £300,000 worth of tax relief. If you've paid your tax for that year and then claim the EIS relief, then HMRC will give you back the £300,000. That's doubled if the investment is into a knowledge intensive company. You have got the option here, if you invest in this particular year and you look at it and you think, well, okay, I haven't got £300,000 worth of tax paid this year, but I did last year, you can elect to carry that back into the previous year and then get your tax back that way. Tax relief is limited to the tax liability for the year. So if you invest £1 million, you want your 300,000 back, but you've only paid 250,000, that's all you're going to get back. The revenue are not going to give you that extra £50,000 extra in your pocket. Income tax reliefs and capital gains tax exemptions. So the gains on disposal of EIS shares are exempt from capital gains tax. So if you invest £10,000 in shares today, and let's say in 20 years' time, they're worth 20 million, and you cash out at that stage, either perhaps because the company is becoming a listed company or something like that, then that gain will be tax-free. And it would have been the perfect investment for you as well, I suspect. However, as I mentioned just now, you must have claimed at least £1 of income tax relief, which subsequently must not have been withdrawn in order to get that relief. And the shares must have been held till their termination date, which will be, in this case, the sale date. As I say there, make sure that the income tax relief is claimed. If necessary, you can disclaim personal allowances. So if for example, you have a personal allowance in a particular year, subsequent year of maybe £10,000, 12,000, whatever the figure happens to be, and you have £10,000 worth of income so that it's covered by your personal allowances, you can effectively disclaim the personal allowances and claim income tax relief on the basis of your EIS investment. Now, although to you it doesn't make any difference, you're not actually getting any tax back at all because you didn't pay any in the first place, you're still using that EIS income tax relief, and that then gets you the capital gains exemption at the end of the day. It says there manage income streams, so I've already mentioned about the possibility of having more tax paid in the earlier year and claiming it back. What you will want to try and do is look at the level of investment you're going to put in and make sure that you maximize your tax reliefs and don't overcook it. If necessary, you might have to invest at 2 different times if that's available to you. So you need to plan your EIS investment wherever you can. There's also a capital gains tax deferral relief, or often referred to as reinvestment relief. What you can do here is, if you've made a capital gain separately by selling something else, it could be pretty much anything, property, shares, any capital asset on which capital gains tax would arise. If you made that disposal within the period of 3 years before to 1 year after your EIS investment, then you can defer that capital gain from being taxable. Now, I've stressed there, it is only deferring it, it isn't eliminating it altogether. In this particular scenario, there is no £1 million limit for the year, and there's no 30% limit on the shareholdings. So you might not qualify for normal EIS tax reliefs because you've exceeded those particular limits. But you can still, because the company is a qualifying EIS company, you can still get the benefit of a deferral of capital gains that you've made previously. The gains do come back into charge. This is usually on disposal, or if the EIS company has a bad run and goes into liquidation or stops trading and has no value in it, then at that stage the gain will come back into charge. You need to be aware of that because the tax will then become payable at that stage. You also need to watch out for losses that might arise on winding up an EIS company because that gain is still chargeable. Other things to be aware of: if you're deferring a gain now, and this is perhaps fairly poignant at the moment where capital gains tax rates might only be 18% or 28%, the capital gains tax rate may well increase in future. And there are certainly discussions going on about whether capital gains should in future be taxed as the top slice of income, so going back up to maybe 40 or 45%, which it has been in the past. However, if the gain on which you're trying to defer qualified for what's entrepreneurs relief, and so you were only paying 10% tax on that, then that continues. So you should only be paying, at the moment, 10% in the future. So that's at least useful, and you may be able to lock that in. There's also loss relief when EIS companies don't have the best of a run of it and end up going bust at the end. In this case, the loss that you can claim against other income is the loss that you make net of the income tax relief that you've already claimed. and this then goes against capital gains tax, or you can carry it forward and set it against future capital gains. There's an example that's given here just down the page. So EIS cash subscription originally being £100,000, you've had your 30% tax relief, that's 30,000. You're then going to get loss relief, hopefully, if you've got lots of income, 45% on the balance of the 100,000 less the 30 you've already had. So that's 31,500 you will get back. And in that case, your net loss, in other words, the net cash that you've really suffered out of your pocket is 38,500 or 38.5%. If you've got any previously deferred gain into your EIS investment as well, that will come back into charge. There's also a possibility that in this particular situation, you could elect for that loss, instead of it being against capital gains, in that year, you could claim it against your income for that year or possibly the previous year. But if all goes well, at least with the company, there can be other situations that arise, and potentially if it goes on for a long time, you might keep the investment and something might happen to you, the investor, such that you die. And what happens at that stage? Well, for inheritance tax purposes, business property relief generally will apply. Now, it's not specifically an EIS relief, but it will apply generally with EIS companies because they tend to be qualifying trading companies and therefore qualify for business property relief. The relief is 100%, so there won't be any inheritance tax on the value of the shares that you've got, providing you have held those shares for a minimum of 2 years. So in effect, the inheritance tax on the value of these shares will be nil on death. Now we're going to have a question. Over to you, John.
Yeah, so here's our next poll of the day. So here we go. Is your business less than 2 years old?
I'll give you a little while to answer that.
Give you a few more seconds. Okay, so let's share that. You guys see the majority of businesses in here are less than 2 years old.
Excellent, thank you. In which case, the next slide may well be of interest to you. So very early startups, as I said, back in 2012, the Seed Enterprise Investment Scheme was introduced. It was seen as being a necessity because for early startups, there didn't seem to be any reliefs out there which would help particularly early startup companies. So there was some enhanced tax reliefs that were introduced just for early startups and based on smaller amounts of money. So the income tax relief here is at 50%. Now it's obviously more than the 30% that you get for EIS investment, but interestingly, it's a rate that's higher than the highest normal income tax rate that you'd be paying of 45%. So if you make a £100,000 investment, you could get back £50,000 from HMRC, providing you have paid £50,000 in tax that particular year. So your income ordinarily would be more than £100,000 in order for you to claim back that level of tax relief. So you need to just keep an eye on that if that's what we're looking for. Again, you can have the tax relief in the year that you make the investment or carry it back for 1 year. But here we've got a maximum of £100,000 per year with the carry back. So you might possibly look at investing £200,000 in 2 different chunks, one you carry back to the previous year and one in the current year. The company must be under 2 years old, hence the question just now. 2 years is actually in the rules from when activity in the company starts, and that can be a pretty grey area. I would generally suggest that it's within 2 years of incorporation, because then no one can possibly argue that the company has been around for longer than that. But if you're in the situation where the company is slightly older than 2 years old, then we might need to look at when activity in that company started, particularly if it's perhaps not done anything at all, it's just sat there for a year before you've actually woken it up. Again, capital gains tax exemption on the sale of the shares, providing you've held them for a qualifying period. Capital gains tax reinvestment relief on up to 50% of the gains. This is different to EIS. It is not a deferral here. It is actually a reinvestment into the seed EIS shares. So if you've made a gain elsewhere, and you're reinvesting that gain into the SEIS shares, then you in effect will get relief on that reinvestment, so that you're only paying half of the tax that you would have paid otherwise on that other capital gain. Now, of course, you still got to pay half of the tax to the revenue, but that gain is, or half of it is effectively then rolled into this particular disposal, or this investment. Same year as the income tax relief again, so you need to watch out for that. Okay. I mentioned earlier about business angels and EIS, so and in particular company directors do not normally qualify for EIS relief unless they meet what's called business angel rules. There are two options here. So you can either be, if you're going to be a director, unpaid and not entitled to any remuneration whatsoever, or providing you're not a director before the first EIS investment and you meet other conditions, then it's possible you could get some remuneration. So what are those other rules? Okay, so unpaid directors, that's fine, there's no argument there. There will be some permitted payments that can still be made to unremunerated directors. And in those scenarios, permitted payments include necessary expenses, commercial interest, rent, dividends, etc., payment for goods. So if, for example, you're an investor into the company and that company is renting commercial premises from you, then that's fine to pay a normal market rent on that property. Reasonable remuneration for services. Now there's a bit of a tricky paragraph here, which I'm going to read out word for word. And that remuneration is paid for services rendered in the course of a trade or profession other than secretarial or managerial services, or services of a kind provided by the person to whom they are rendered. And not surprisingly, it's got to be taken into account in calculating that person's tax. Now, the first bit of that initial paragraph is paid in, for services in the course of trade or profession. That's generally not a problem. And it's fairly obvious if you're supplying secretarial or management services, which isn't allowed. The next bit, or services of a kind provided by the person to whom they are rendered, is a bit more tricky. So what it's basically saying there is, if the EIS company is, for example, making widgets, manufacturers widgets, and the investor's company manufactures widgets as well, then if he's providing services to the EIS company because it's the same trade that he's providing, then they won't allow that. Clearly, it needs to be something different. Sometimes it can be very obvious it's different. There can be a bit of a grey area in between. So the upshot of that is you need to be aware of not only who your investors are, but what they do before they're providing any services to you, to make sure that they don't come unstuck with their EIS reliefs. Payments to connected persons, including a personal service company, are treated as payments to the investor and could also be receipts of value leading to loss of EIS relief for the investor. So receipt of value I had mentioned before. So paid directors and qualifying for EIS relief, they must not, under any circumstances, be entitled to any pay or remuneration before their first EIS investment is made. Once they become paid or entitled to remuneration, further investments can qualify, providing they are made within the 3 years of the last EIS investment before they became paid. So an example here, 1st of April 2020, chap comes along, makes his EIS investment, and the shares are issued on that date. 1st of May, he's appointed as a salaried director. If he's going to make any further EIS investments in that company, he's got to make them by 31st of March 2023. In other words, 3 years after the 1st of April 2020 date above. So that is another trap which quite often gets forgotten about. Oh, I've made EIS investments, I've got my release, so I must be able to get further ones later on. So just be aware of that particular one. Other pitfalls for EIS investors. In order to claim EIS relief, an investor must not hold any shares which are not EIS shares, as I mentioned earlier on. More importantly, when you actually come to do and deal with the EIS investment, they must be from subscriptions for new shares. The EIS shares must be new shares issued by the company and must be paid for in cash, i.e. the shares don't come from another investor, even if they had EIS relief. That sometimes causes a bit of an issue. So typically you might be going around asking for money for investors, and someone will go, yeah, fine, I'll give you the money tomorrow. Someone else sends you a check and it takes a week or so to clear, and all the different monies are actually coming into the account at different times. What you need to make sure is that you keep those subscriptions in a separate account, all ring-fenced, and then you issue all the shares at the same time on the same day. Otherwise, you can easily come a cropper there. Associates need to watch out as well, so they will be disqualified from getting the tax release if they or an associate is an employee or director of the company. So if someone invests, say, £100,000 in A Limited, and then a couple of years later, his grandson's perhaps looking for a bit of work experience. He has a quick word with the CEO and says, yeah, you can come along and do a bit of a summer job for me for a couple of weeks. Gets the holiday job, the shareholder then loses his EIS relief. And in this particular case that this one refers to, £30,000 of tax relief was clawed back by HMRC, and he lost his capital gains tax exemption as well. So he wasn't best pleased for helping out his grandson, who probably had no more than a few hundred quid's worth of work in that holiday period. Other pitfalls, there are, as you've already seen, lots of detailed rules. Investors and associates together must not hold more than 30% of the shares. The investors and associates mustn't be employees, apart from the business angel rules that we've already covered. The rules don't stop when the investment is made, but go on for at least a period of 3 years after that initial investment. And that's where some of the problems can come about, because people forget about it, and then something happens, and then the upshot of that will be if the revenue finds out, then they'll come back and claw back some or all of the tax relief that's been given, depending on circumstances. And you might say, well, the revenue will never find out. Sometimes they do, and sometimes they find out from some very unusual avenues. If you have a disgruntled shareholder or disgruntled employee, or someone else who's maybe sold their shares and got relief which they shouldn't have, and the revenue find out, they then start asking questions of the company about exactly how the funds were dealt with, how the shares were issued, etc. And then it can become a very difficult discussion with all your EIS investors if you're having to tell them that they've just lost all of their tax reliefs. Timing there, receiving the cash and issuing the shares, I mentioned just before. Another one that can be particularly difficult to deal with is if things go quite well, or you find that you're having to go into a different market. So changes or development in your business model. If you go through a restructuring exercise, then that can prove problematic if it's not dealt with in the right way. And you also need to watch out with interaction with other share schemes that you might have as things develop. So it may not be all SEIS and EIS shares. You might have some other share schemes that are out there that need to interact with this. The upshot of that is you need to talk to your advisors before you do anything, particularly along the restructuring or interacting with other share schemes. Needless to say, with the generosity of, as I put there, of the tax relief offered by HMRC, there are complex rules, and particularly with EIS, it's been around 25 years, so you tend to get layer upon layer of rules, which become more and more complex over the period of time. And with the complexity, as well as some interpretation that comes in there, it can make life very difficult. Not least for me, but also for you, because you're not going to understand most of what's going on. A couple of points here. If things go well and you want to look for an AIM listing, you might think, oh, listed companies are not allowed. AIM listing is treated for these purposes as an unquoted company. Has to be a trading company, not an investment business. As I said, with the SEIS, watch out for the age, 2 years, etc. There are some rules on level of gross assets, which I shall come on to in a moment. Independence and qualifying subsidiaries. This is where you're having a restructuring and maybe a group scenario comes up. There are some limits on number of employees for company size, and various, needless to say, excluded activities which the revenue don't want to give these reliefs for, principally because they don't regard it as being sufficiently risky. And the whole purpose of EIS and SEIS is actually to encourage investment by investors into relatively risky businesses, which they wouldn't necessarily invest in otherwise. So let's take a look at the company rules. So here I've got another table with the different types of reliefs that are there. First column is the SEIS, second column is the same for EIS and VCTs now. And then the third column is KICs, which are knowledge intensive companies. And I'll come on to that in a bit more detail in a moment. So age of the trade, 2 years for SEIS, as we've mentioned. Gross assets, I stress the word gross assets, so that's before any liabilities are taken off, must not exceed £200,000. Maximum number of employees has to be less than 25, so they'll look for full-time equivalents here, so you could have 24.5, for example. Maximum investment in the company is 150,000, and for the individual is 100,000. So you could have two individuals investing 75,000, or one investing 100,000, but you couldn't have two investing 100,000 each in a particular year. EIS, much more generous. Age of the trade there I've put as 7 years. that doesn't necessarily mean if you're older than 7 years, you can't get EIS release. You can, providing you have had SEIS or an EIS round in the first 7 years. So that unlocks a second wave later on, should you need further investment, which typically most businesses do. So you may well find, particularly with yourselves, as most of you are early startups now, you'll be looking for an SEIS round just to get things moving and off the ground. You'll get some funding in. You'll then look to maybe develop things a bit further. So you might need perhaps a couple of million from an EIS scheme. And then you might need to develop it further, take something to market, expand into new areas, take things offshore even, and expand into other countries. And you might need a further round of investment at that stage. So looking at the gross assets for EIS, you're looking up to 15 million before the investment and 16 million after the investment as a maximum. More employees there, have to have less than 250, and you can read the others there. It's usually double the employees for knowledge intensive companies. Maximum investment is 20 million as well, but only 10 million in a 12-month period. And then the maximum investment for an individual is 2 million. So there's quite a lot more investment available with knowledge intensive companies, and I'll come on to a bit more detail of what they are a bit later on. Okay, so the age requirements, as I said, SEIS companies up to 2 years old, that's measured from when the company commences trading, and trading means basically open for business. As I said earlier, it's easier to avoid the whole argument in the first place and have the company as less than 2 years old anyway from incorporation. EIS and VCTs, less than 7 years old, that's measured from the first commercial sale. You could have a sale to test the market, but then you would generally ignore that. Again, try and ignore the whole thing altogether so that there's no argument over it, because it can be quite an expensive one, either in arguing successfully with the revenue or indeed if the reliefs are lost. And then knowledge intensive companies have to be less than 10 years old, and that's measured from the date again of the first commercial sale or the end of the accounting period in which their turnover reaches 200,000 per annum. Now that can be a bit more tricky if you have a long accounting period or a short one, because they'll pro-rata it and see whether you're getting on average 200,000 a year. SEIS companies, gross assets 200,000, as I said, that's before deducting any liabilities. Watch out though for the valuation of any IP that's being introduced, because that could change things. And then similar for EIS companies, 15 million before the investment, 16 million immediately afterwards. Again, that's gross assets before liabilities. Interestingly here, if you have got a group of companies, then you're effectively looking at, or you might look at just the consolidation situation. But what the revenue do is they look at each of the companies individually and then remove anything that's intra-group. And it can have a slightly different result. So you might need to be careful of that and have your accountant review that before you go ahead to make sure that you don't exceed the limits. More rules, excluded activities. Now these are fairly definitive, so and generally these activities are there because they're not classed as far as revenue are concerned as sufficiently risky investment for the investor to put their money in. Not surprisingly then, dealing in land, shares, futures, financial instruments, and further down property development, generally bricks and mortar are a fairly safe bet, which is why people generally can't get EIS relief on those. And then there are various others there, just make sure that you're not falling into one of those. Needless to say, accountancy services is amongst them, so I can't get it either. Okay. Another one is in relation to license fees. The receipt of royalties and license fees is an excluded activity unless the company issuing the shares has created the greater part of that value of the IP itself. So if it starts out, generates whatever it is that's really valuable, has a lot of intellectual property in it, and then effectively is franchising that out and getting royalty or license fees from it, then from doing that, that won't probably be an excluded activity because you've generated it in the first place. However, there can be some situations where things develop, you're doing okay, but invariably things tend to spin off from what you're doing, and there is an allowable tolerance here of 20% of having up to 20% of non-qualifying trade or bits of items that are in there that don't normally qualify under that list that I've just shown you. Providing it's less than 20%, that's fine. However, the thing to be aware of here is the way the revenue will measure that 20%. There are lots of measures that they can use, and we quite often look at turnover or profit, assets employed, which would be perhaps employees working on certain areas of different bits of the trade, etc. The revenue will pick whichever one disqualifies you. So avoid, if you've got any of them that are getting close to that 20%, make sure you stay below it and that you are demonstrably below it so that they cannot then go, oh, well, that one's over 20%, even though the rest are below 5, doesn't matter, one's gone above it. Therefore, you potentially could be in trouble there. And if the company then fails to qualify, then all the EIS release that all the investors get gets clawed back, and you would not be popular. So, in order to secure the tax release, investors must hold their shares for at least 3 years, as I mentioned earlier, and the company must continue to meet the relevant requirements throughout that time. So, no disqualifying bits of trade in there that exceed 20%, for example. So you carry on your qualifying trade, you're independent from other companies, and you have qualifying subsidiaries if you've got any. That will carry on for 3 years. You also need to make sure that in that 3-year period, at the start date, at the beginning when the share issue is, the number of employees and the gross asset tests are made, and you're okay with those. If you're going to get further investment down the road or you're planning on it, then make sure that you keep below those so that when you do the next share issue or come to look at the next issue, you haven't gone above those limits. And that's quite often the case. You will be looking for several tranches of investment before you're flying. One thing to watch out for is trading in partnership. So joint ventures are generally a no-no. But if someone does come along and wants some form of partnership agreement, you need to watch out just because it could simply be the supply of services, for example, rather than actually working in partnership. If I were you, I would avoid the whole area of joint ventures and working in partnership because it can be a very problematic area. Good for fees, but problematic for you. There has to be a risk to capital requirement, and the revenue do ask for this. They do look out for it and consider it when an EIS application and an SEIS application is made, although it tends to be less of an issue for SEIS because it's right at the very beginning of a business anyway. But you will need to demonstrate there is a genuine commercial risk, that the value of the investments that the investors are putting their money in basically could go down as well as up, which is why if you're investing in property, it's non-qualifying, and that's because it's a fairly safe bet. if we're looking at developing a brand new product here, which is quite often the case, and you'll be doing some research and development on that product, then of course the risk is that actually you can't develop it, or you get it to a certain stage and then you realize it doesn't work, and everything falls down around your ears. That's the risk that is a genuine commercial risk, and you may need to demonstrate that to HMRC if they ask the question. And we have another question. Over to you, Josh.
Thanks, Colin. So we've got our third poll of the day, and this time the question is: Do you think your company is a knowledge-intensive one? So we've got yes, no, and don't know as an option this time. But if you don't know, that's fine. Okay, let's give it a couple more seconds. Okay, so a mixture of results there, and there we are.
Okay, not surprising. Fairly even, Stephen, across the board, I think. Okay, so I'm conscious that we're getting a bit short on time, so I'm going to have to fly through these. So what is a knowledge-intensive company? As we covered before, there are some better or more enhanced tax reliefs available, and larger amounts can be given. So revenue will look at, and you'll need to produce evidence to this effect, that 15% of costs spent on research and development in one of the last 3 years exists, or 10% of costs spent on R&D in each of the last 3 years, and you're engaged in work to create intellectual property or IP, and it's reasonable to assume that within 10 years most of the company's activity will consist of the exploitation of that IP, or at least 20% of the workforce are skilled employees, and I'll come on to that here, so that they have a master's degree or higher and are directly involved in the R&D work that's going on. There are special rules for companies that are less than 3 years old. Advance assurance. This is a key area. So if you've got a company that you want to get EIS or SEIS relief, if you're going to take it out to market, one of the first things they will ask is, have you got an advance assurance yet? It's not compulsory, but particularly with fund managers, they'll insist on it. And any business angel groups will generally look to see whether you've got advance assurance. It's not difficult to actually go through the process, and if you meet all the conditions, then it's not a problem. There's no obvious reason why you wouldn't do an advance assurance, because even if you don't do it, you're going to have to do all of this work later on when you actually make the main application to HMRC anyway. Indeed, if you don't do an advance assurance and then it all goes belly up later on, then there is a potential, if it all goes badly, then there's a risk to the directors themselves. Question mark, have you been negligent in not doing an advance assurance? It's relatively straightforward to do. So most companies start, as I say, with advance assurance application. It involves completing a form and a checklist and sending it to HMRC. This is now online, so it's not too difficult to complete. The only pain that I go through with these forms, or at least if you're looking to do this yourself, is you can't look at the complete form to see what information you need, and then go and dig it all out and then bring it together to put it on the form as you complete it. So you have to look at each page as you go, and some of the questions will ask you various points, and then may well then ask you further questions depending on what your answers are. But as a general rule, you'll need to have a business plan, financial forecasts, budget setting out what you're going to spend the money on that you get from EIS investment, have the company articles, that's straightforward, any shareholders agreements if there are any, and a list of your investors, which can be tricky when it's an advance assurance and you're just starting out and you're thinking, okay, I want to go out to market to get my investors and I don't know who they are at the moment. But you may well have one or two who've already said or know you or whatever and said, yeah, we'll put some money in. So you can put them in there and the others to be advised later on. And that's usually fine because the revenue are generally looking at all the other stuff that you're sending through. Financial forecasts need to be for a period of 2 years. Business plan, watch out, because if you've done anything on social media beforehand, then the revenue may well find it because they do scour that and look out to see what's going on, and also make sure that you're not bringing in a business or something very similar that you have done in the past under a different life, perhaps. So watch out for those. So let's assume you've had your advance assurance, you've gone ahead, you've got your investors, they've all put the money in, you've issued the shares, and we're now at the point where you've issued the shares and we're all ready to go and get the tax relief. What do you need to do? So having done the advance assurance, you now need to submit a form, either SEIS 1 or EIS 1, which is a compliance statement to HMRC. If you've obtained the advance assurance, then that's actually very straightforward. If you haven't, then all the stuff that you would have done for the advance assurance, you will need to do this time round, as I mentioned before. Some of the bits and pieces can be complex or difficult to put together, sort of business plan, etc. like I mentioned before. If you need any help with that, then of course BDO are the people to come to for that. Once you've sent in the SEIS 1 or EIS 1, the revenue will then generally issue what's called an SEIS or an EIS 2 form, and that confirms the trading status and the availability of the company being qualifying and therefore EIS or SEIS reliefs. They will also send out a relevant number of EIS or SEIS 3 forms. Now that's one for each investor, and they are restricted forms, so if you mess them up or any get lost, then you'll need to explain that that's happened and ask for some more, and they will want to know precisely the number that you need. The EIS or SEIS 3 forms, you need to complete a little bit of that, and some of the information is on the EIS 2 form that the revenue has sent you, and its name and address of company, etc., qualifying date. And then the whole form goes to the investor, and they then complete whichever part of the form they wish to complete in order to obtain either the income tax relief, deferral relief, or whatever it is that they're going to do, and then they submit that form to HMRC. So other things that you may well have seen in the press recently, SEIS and EIS and VCTs are forms of state aid, and there's been a lot of complex rules surrounding the schemes because of the EU state aid regulation. With Brexit, will those rules be abolished, or will the EU try and tie us in with their trade agreement to levels of state aid? Who knows? I suspect if the shackles are really released, then we may well find that a lot of the complexity for EIS, etc., is removed, or at least the investment limits might well be removed or changed significantly, because the Chancellor, for one, will be looking to get business going again in the UK, get it generating turnover and paying its taxes, so that he can refill his coffers that are now empty, and start paying off some of the debt that we've got as well. That, amongst other things, which are also state aid and therefore come under the EU regulation, for example, research and development, I suspect will also come under the same banner. on that, we have more questions if we have any.
Thank you, Colin. Yes, we have got some questions, but whilst we're collating those, I'd just like to do our final poll. Josh, would you like to run that for me, please?
There we go. And this one is, do you plan to alter your fund raising strategy as a result of this webinar? Okay, just give it a couple more seconds for everyone to have a chance. Okay, and there we go. So a couple of people will be altering their fundraising strategy after that, Colin. So thank you for your information.
Okay, well, I hope that that's been useful. The rules are complex if you're looking to get SEIS or EIS relief, and they continue to be complex. So please do involve an appropriate advisor to give you the information that's needed and to make sure that you stick within the rules to avoid upsetting your investors at a later date.
Thank you, Colin. And yes, we do appreciate that BDO and yourself have got a wealth of experience. Other advisors are available. Now, going to the Q&As, one of the pressing questions which has been coming through quite frequently is, with the Future Fund, they are convertible loan notes. And the question arises, if you take out convertible loan notes, would you be able to still apply for EIS either at the same time or subsequently?
If you do it subsequently, you will have had loan notes before the EIS application. As I mentioned in one of my earlier slides, a loan of any sort is going to effectively disqualify you from being an EIS investor. If you got the loan notes after your EIS investment, then it's very likely you will be getting some value from the company, which would be interest usually attached to those loan notes, and that will then result in a clawback of EIS relief or possibly removing it altogether. So yes, avoid loan notes if you're doing an EIS investment.
So effectively what we're saying is the Future Fund, which runs out at the end of September, is unlikely to be renewed, is not a route to take if you're looking for EIS investors.
No, no. Do either the loan notes or EIS investment.
Right. Okay, got a question from Morris. Can you expand a little on the IP valuation pre-investment? You mentioned that watch your IP valuation because it could affect your gross value.
Yes, so IP is very difficult to value, but if you're doing any reorganization before you then have a future investment, either by second round or something like that, then generally the value of IP will sit off the balance sheet. But in some circumstances, it can end up on the balance sheet or indeed be very valuable, but sitting in the background. And if the revenue are aware of it, then the value can be taken into account because in effect, you're looking at the value of the company. And if the value of that IP, for example, were £20 million, then you could find that the value of the whole company exceeds the gross assets value because the IP will be an asset and liabilities are not taken into account. So you need to be very careful with IP. Having said that, the value of IP in early startups is likely to be minimal. It only really comes to the fore at the point at which you're taking something to market and it explodes in value at that stage. The issue we will have here is the benefit of hindsight as far as revenue are concerned. So at the point in time at which you're issuing your EIS shares, the balance sheet might show next to nothing, but then 18 months later, the value of the company is 50 million. So where did that value come from? What did it come from? And look back and go, well, that IP was there at the time that you issued those shares. Therefore, we think the company actually was worth much more than what you've shown. And then you have problems, unless you can say, well, actually, we had an issue, and the further investment then enabled us to do the R&D to overcome that issue, and it was only then that the real IP value came to the fore. And I have had an SEIS company in my area where they were looking to create a certain product, and they were very nearly at the point of taking it to market. But there was one problem they couldn't overcome, and in the end didn't overcome it. But just before that, you might have valued the company quite a bit higher, because there were some big supermarkets that were looking to acquire the product that this would have generated from it. So it can be difficult.
I think it's worth mentioning that you could go for your EIS or SEIS pre-qualification, then subsequently talk to the experts who then value your business for share purposes and trip up over in that process by confusing the situation. So it does need coordination right from the start.
It does, and invariably if you're looking for investment, then you'll want investors to put in as much money as you can possibly get. And of course, if you're saying, well, a company's worth £20,000, but I want you to pay £20,000 per share, an investor won't pay that unless they think realistically they're going to get a decent return from it. So there would have to be something that's hidden there, which you're not outwardly telling certain people about.
Yes, so it becomes a grey area. That's where I'm coming from.
Yes,
certainly.
Yes.
I mean, $6 million question, really, and I shouldn't really ask this question, but I will because someone else has asked it. So I deny responsibility. And that is it actually worth going for EIS, SEIS? Surely you're better off running without all the tax relief.
You'll often find that it's a new door that is opened with EIS and SEIS. The real benefit of EIS investment is when you find that company that goes stratospheric. You put in your 20, 30, 40,000 pounds initial investment in the likes of Microsoft 30 odd years ago, and you want to sell your shares now, and they're worth 30 million, for example, and there's no tax to pay. Ordinarily, if you've just gone through the normal channels, whoever's investing in the shares in your company is going to pay tax on the end of it if there's a gain. And if it's gone really well, then they're going to pay a lot of tax at the end of the day, compared with nothing. And it's therefore, if you can, worth going through the hoops if you've got various people that are interested in EIS or SEIS investments. If you've got foreign investors, then they're probably not going to be interested in using that vehicle, in which case just go for normal shares being issued. But it does open the door in the UK. And as I said right at the beginning on my first slide, an awful lot of money has been invested under the EIS banner in the last 25 years.
Thank you, Colin. I think we need to bring it to a close. We have overrun, for which we do apologise, but the subject matter is such that it does require that in-depth investigation. So once again, my thanks to Colin and BDO for presenting today. And please look forward to next week's presentations on Tuesday and Wednesday, same time, 2 o'clock, where we will be looking at pitch decks and everything that you need in a pitch deck. And on Wednesday, the opportunity for those who wish to actually pitch before a panel. And that should be an interesting situation. As I said, if you are interested in pitching live in a webinar for the practice and for possibly future funding, which may be available very shortly, please let us know on uez@essex.ac.uk. Once again, thank you very much indeed for our panelists today, and safe journeys home.